Welcome to another episode of Millennial Investing Explained. Here's today's question. I want to talk about the last strategy that we're going to cover here, and that is dividend investing. And so what dividend investing is essentially when you buy companies that have a high dividend yield, which means they pay out a lot of their profits as dividends to their shareholders. In general, because the companies are paying out a lot of their profits in dividends and they're not retaining it for themselves and reinvesting it in growth, these companies tend to grow slower. They tend to be more stable than your high growth companies. And for that reason, you usually just get stable income from the dividends, but you don't get a ton of growth or appreciation from the stock. And because of that, this strategy is generally recommended to investors nearing retirement or in retirement because they need less volatility and more income for their retirement time. But I'm curious to get your opinion, Preston. Could a dividend strategy be beneficial for a millennial investor?
I personally don't think that it would really benefit a millennial investor all that much. I think whenever you're younger, you have big opportunities to make mistakes and kind of go after the bigger returns. And I would tell you, I would not go after the bigger returns in necessarily financial markets. I would tell you to go after the bigger returns in creating operational businesses. If you really want to create value for yourself, you gotta try to create an operational business. When we study all these different billionaires and all these different people, you know, we focus a lot, and I think it's just because it's a bias that Stig and I both have because we thoroughly enjoy stock investing and we like the math associated with stock investing and that kind of stuff. But that's all non-operational subsidiaries that we buy for a business. It's the money that you employ because you don't have a great idea to invest operationally in your own business that you then basically outsource the purchase of some other financial asset in order to get some type of return on that. As a young 20-year-old, young 30-year-old person, you have a big opportunity to go out there, invest in yourself, invest in something that you can create a low-risk business that can quickly prove whether it's going to be something that works or something that doesn't work, and you can invest that way as well. And I think that that's something that is often neglected and should be talked about way more is, do I invest operationally or do I invest non-operationally? All the stuff that we've talked to up to this point in time is all non-operational investing. It's the stuff that you do where you don't have a great idea to invest in something that's going to give you a 300% return on your money by next year. And when you're operating at a very micro level, call it your business is you, yourself, and yourself, you can get those kind of returns on your money if you go out there and you put a little elbow grease into whatever it is you're doing. You can get a 5,000% return on your money if you go out there and you create something. That money's to be had. That's for you to figure out. And I would tell people, start thinking that way. Start thinking of what can I do to start my own business? What can I do to participate in a startup or whatever where I'd get a small portion of the equity? That kind of stuff is insanely valuable. And I know I totally shifted gears out of the dividend investing strategy, but I would argue a value-based strategy where you're investing in a stable business usually has dividends associated with it. And so you're just getting you're getting some dividends, you're getting some earnings that are being retained inside the business. And so I kind of look at the strategy as being very similar to just a value-based company that's stable.
I think one of the biggest hurdles for millennial investors is that they think they need to build the next Apple or Uber in order for their business to be successful. But I just don't believe that that's the case. You could take a couple $1,000s that you have that you were planning on investing in the stock market, and you could invest it in an operational business like you said. Maybe it won't become worth billions of dollars, but say the business becomes worth $100,000 or $200,000. That's still an incredible return on investment. That's an ROI that is very difficult and highly unlikely that you'll be able to match it in the stock market. And even if it isn't $1 billion, these types of businesses can go on for a significant period of time. And maybe it's a few $1,000s a month. That type of money, even if it's not billions, it can change your life.
You know, this is going to sound totally ridiculous, but I'm going to say it anyway. You could go out if you had $5,000, okay, you could go out and buy yourself the cheapest truck with the cheapest trailer, and you could go buy a $1,000 lawnmower. And if you had just ridiculous work ethic, you could go out there, start knocking on doors. Next thing you know, you could go spend $50 on a spreader and start selling fertilizer at a markup of 300% from what you're buying it, and go start spraying yards. Like, You could get out there, get your hands dirty, work your tail off. But after doing that for 3 years, you might be sitting on $100,000 of money if you really got after it. You had great marketing. You had great personality when you're there talking to people at the door, selling your service, undercutting every competitor that's out there, dropping your rates, whatever. Ask them what the other person's selling their service for. You drop the rates. Like, this is just like bare bones, like grit that you could implement literally right now. And you could knock the socks off of somebody who's coming out of whatever business degree that's now going to go work for some company and make $50,000 a year, but they don't own something. They're creating value, and they're creating a bigger bottom line for another person opposed for themselves. And I mean, I'm just throwing out the easiest, most generic thing I can think of. And so for people that are listening to this, there's something that you're great at. There's something that in your past and in your history gives you a competitive edge at something. You just got to figure out what that is and what has happened in your past that has put that asset and that opportunity right on your lap. And then just exploit the living heck out of it. And whatever your competitor's doing, go study it, right? Study the heck out of it, figure out how to do it better, and then go and do it better. But it requires a ton of work, a ton of effort. But in the end, you'll have something that is extremely valuable. Anytime you're creating equity for yourself through your labor and your time, will often produce ridiculous returns if you stay at it and you work hard and you try to figure out what your competitive niche is.
And not only are you potentially getting better returns by doing that, but you're also likely becoming a better investor. Warren Buffett has a quote saying, "I'm a better investor because I'm a business owner, and I'm a better business owner because I'm an investor." So they can go hand in hand and they can help each other out, and you can definitely do both.
And you know what? Buffett, 65 years ago, Warren Buffett, when he was like age 16, he was worth $50,000 at age 16, 65 years ago. So if you would figure out what that's worth in inflation dollars today, you know, he was worth a couple $100,000 back then as a 16-year-old. And you know how he did it? With a paper route, throwing newspapers. That's insane. But what it is it's hard work and it's freaking grit. And that's how this dude got started. That's how this guy crushed it. And so then what did he do with his $50,000? He went out and he started buying pinball machines. And then he worked a deal with barber shops to put the pinball machines inside the barber shop. And he would give the barber a cut of the money that came out of the pinball machine so that he would have them on site. So he's there working deals. He's out there buying more assets that he doesn't have to, that don't require his time. Anytime you're starting out, it's going to require your time. But then after you retain some earnings, then you can go out and buy other assets that then kind of don't require your time. This dude was doing this in his teens and he was crushing it. I guarantee you there wasn't a kid in the entire United States that probably threw more newspapers than Warren Buffett at age 16. There's no way.
That's all for this episode of Millennial Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.